In this video, I'm going to talk about how bridging finance works. Bridging finance is a flexible, short-term form of funding that can be arranged quickly. They are ideally used for short-term funding gaps or to transition an asset, perhaps through planning or a refurbishment. Most seasoned property developers will have used a bridging loan at one point or another in their careers. They're a very useful financial tool, so it's well worth knowing how bridging finance works. The key features of bridging finance. Bridging loans have some key features that make them particularly useful. First of all, they're fast to arrange, with some lenders completing in a matter of days or hours. Being able to access large-scale funding within 3 days might just save a property project or provide the immediate liquidity you need to secure a sought-after site. Secondly, bridging is extremely flexible. So anything from 1 month to 18 months, typically there's no fees for repaying early and as long as you've passed the minimum loan term. Another key feature of bridging is how they're assessed, how the loans are assessed. The biggest concern for lenders is the exit strategy. In other words, how are they going to get their money back? This is great for borrowers with a strong project because it means things like credit history and their income are less important. Interest is rolled up and paid at the end of the loan, which is again why income and affordability tests are not as important in securing a loan. Typically, bridging loans are capped at 75% loan to value on a gross loan basis. So borrowing costs will be deducted from that unless you're up to service the loan. Better rates start to kick in at around 40% deposit though, so it's worth checking whether the savings could be worth the bigger investment. How much you can borrow is a pretty vast scale, stretching from £50,000 to 50 million. Using assets to secure the loan. The other aspect of bridging finance that's pretty important is that it's a secured loan. Much like when you buy a property with a residential mortgage, that property is the securing asset. So in the event of default, the lender can take possession. The same goes for bridging. But if you're borrowing through a company, as most property professionals do, you will be asked to provide a personal guarantee. A personal guarantee is the borrower's legal promise to repay loans issued to a business where they are a beneficial owner. So providing a personal guarantee means if the business becomes unable to repay a debt, then the borrower accepts personal liability, meaning they can't just walk away. So if for whatever reason things don't go as planned, there is a risk of losing multiple assets. There are a huge number of circumstances where bridging finance can be used, both on residential and commercial properties, but there's a few transactions where they are the ideal financial tool. Primarily, bridging loans were used to bridge the gap between buying and selling a property, hence the name. They're pretty widely used in the UK housing market so people can secure their next home before selling their current home, which massively helps in preventing the breakdown of property chains. Another common use is buying property at auction. Normally a 10% deposit is required up front and the buyer has just 28 days to complete, something that just isn't possible with traditional mortgage finance. Likewise, most mortgage lenders won't consider properties that are deemed uninhabitable, i.e. if there's no working kitchen or bathroom. So for any developer that wants to complete a small-scale renovation job with a quick turnaround on a derelict house, bridging is a great solution. There's loads of other properties that don't qualify for traditional finance that can be funded with bridging loans, like property with unusual or non-standard construction, perhaps a leasehold property with less than 80 years remaining on the lease, derelict buildings as we've already mentioned, property with serious structural issues. Developers will often use bridging loans to buy land without planning or with planning they wish to vary as well. Then once they've got the planning, they sell the land on at an increased value or develop it themselves and take development finance. Then there's also the business of unregulated versus regulated loans. Whether a bridging loan is regulated or unregulated depends on what's being purchased. Commercial property purchases are always unregulated. Residential, however, can be either. If the property is for investment purposes like buying to flip, or buying to let for a complete development scheme, it would be unregulated funding. If the property will be used by the borrower or their immediate family, then the loan is likely to be regulated, meaning it has the same FCA regulations as traditional mortgage finance. Regulated bridging finance requires more paperwork and risk assessment by a lender, so this is likely to be slower to arrange. Something else to consider with bridging finance is that it can either be open or closed, and this entirely depends on the exit strategy. For example, when a bridging loan is used to buy a house before selling a property, but there's a legally agreed date for completion on the property you're selling, the lender may consider this as a closed bridge loan because there is a set date for repayment and a non-speculative exit strategy. An open-ended bridging loan, which is more typical, is where the lender is happy with the exit strategy, but the exact date for repayment is unknown. Like when the loan is used to develop a property that will be sold or let, the exact sale date of the development or when it will be let and refinanced can't be set at the time of taking the loan. There's always a yin and a yang, so bridging finance does come with its downsides too. The biggest drawback is that the interest rates are going to be higher than traditional long-term finance options. But realistically, if the borrowing costs are factored into your profit margins and you've given enough due diligence to the financials of a project, the opportunities provided by bridging through speed and flexibility definitely outweigh the costs. Who can get a bridging loan? Well, anyone really. As long as you're over a certain age, you will be able to get a bridging loan if you can present a strong project with a convincing exit strategy. You'll also have to have sufficient background assets to provide the lender with the personal guarantee that we mentioned earlier, i.e. you will accept liability for the debt. If you think bridging finance might be right for your project or your client's project, comparing loans on Brickflow is one of the simplest ways to ensure the financials add up. By stacking your figures against real-time borrowing options, you can instantly rule out sites that aren't viable. It takes just 2 minutes to search over 40 lenders on Brickflow, which is the best 2 minutes you can spend in your property finance search. If you're a broker, you can apply online in under 30 minutes, and if you're a developer who's ready to apply, tell your broker about Brickflow or get in touch and we'll refer you to our preferred brokers. All details are on the screen, and I'll drop some links to other useful videos and guides in the comments below.